control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Okay, all right, welcome everybody. Thanks for taking the time, making the effort to be here today. Get through the formalities. Disclaimer on the screen. At optionslam.com, we are not licensed financial advisors, nor are we registered investment advisors. Therefore, we do not make investment recommendations. Everything you see in our webinars, including Trades Illustrated, are for educational purposes only. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. I am Marko, and this is my email address. Please, we are very happy to hear from you. Feel free to shoot us an email with your questions or comments or suggestions at any time. optionslam.com@gmail.com. Pretty easy email address to remember. So most of you are here today because you wanted to learn a little bit more about what we do in the background, or what we call the back office tools in support of the Double Eagle strategy. This slide here was shown in the previous webinar representing, I think this one was representing about 1,600 of our Double Eagle historical results. And unmanaged, this is with the attitude of set it and forget it, which is not the way we trade it. We try to, this is showing all the winners and all the losers. If I remember right, the data was, what was it? 69% were winners. The others were losers. This is a graph showing all of those. So anyway, and then taking the trade-off at 0 day produced a 25% profit against risk. That's against total risk. 0 day in a Double Eagle is the front expiration day, the day that the front contracts expire in a calendar spread. Today's presentation is not to discuss the strategy. If you are interested in, and you didn't see the introductory webinar, if you're interested in learning more about the strategy and what makes the strategy work, there are a couple of YouTube videos. Let's see. I'm just a little bit disorganized here today. Let me rephrase. I'm more disorganized than normal today. So bear with me, and I will try to find hang on just a second. I'm going to try to find a way to, I don't think I can copy those. No, not out of the PowerPoint itself. I cannot. I was going to post in the room those links. remind me at the end. Maybe I'll try to find them then. Because right now I want to move on with the presentation. So sorry for that. But I'll try to find them at the end of the presentation and then post those in the chat box so that all you got to do is click on them. So anyway, the point is if you want to learn more about the strategy itself, these webinars would be the ones to watch. Today is not really about the strategy. It's about to give you a little bit of more insight and understanding of what we're doing in the background to help traders, assist traders in being in using the strategy and in implementing the strategy and in becoming successful with the double eagle. So with results like you saw on the previous slide, the question is sometimes asked, why doesn't everybody trade the double eagle? I mean, why have I never heard of this before? Why is this such a obscure, and if it's that good, we would have heard about it, right? Well, there's a few reasons. I have some theories about why this is not a very well-known strategy. Some people call it one of the best kept secrets in the options trading world. There's a few reasons, in my opinion. First of all, the risk graph looks terrible. When you initiate this trade, it looks like you cannot make any money with it. If you look at an Analyze tab on your Thinkorswim or in OptionView or in one software and you model up this trade, the way we trade it, it looks like there is no way to make money. However, the statistics show you and prove to you that we do make money with this trade. Quarter in and quarter out. If you watch the previous webinars about what makes this trade work, you will learn, if you haven't seen them already, that's why I wanted to put them up there for you, but most of you probably have been to those webinars already. You will learn that 3 out of the 4 Greeks are generally in our favor on this trade, as I illustrated to you in the previous webinars. So many people have deducted that IV and theta as well as delta benefits, but when they model the trade up in anybody's Analyze software, they get a risk graph that just looks like it's impossible to make money. So that's probably one of the biggest reasons. I mean, it's not that I'm smarter than any other trader. I'm sure many people have come up with the common sense conclusions that if you combine a theta decay with in your shorts with an implied volatility build in your longs, and when you put that combination together, you should have a winning combination, right? But when you model it up, it looks like terrible. So anyway, another reason. A lot of options traders, and especially those who trade earnings events, are looking for an adrenaline rush. People like all of that, the fast action at earnings. The stock is moving fast, the options pricing is happening fast, they're trading front week options many times. Gamma is extremely high. In this trade, we put this on and it's kind of like slow motion, just easy to manage. You just kind of put it on and watch it for 3, 4, sometimes 5 and 6 weeks. And yeah, not much of an adrenaline rush. Once in a while, we have to adjust our trade. The trade gets to a point where it needs to be adjusted. I would say maybe about a third of our trades. I would say about a third of our trades approximately need to be adjusted. This becomes somewhat challenging and requires some strategy and some effort and energy and analyze and some work. But the other 2/3 of our trades are just truly, they really are set it and forget it type of scenarios, generally speaking. So is not a difficult strategy, but it's not simple either. I like to say there's four things, there's only two kinds of options. There's puts and there's calls. There's only two things you can do with them. You can buy them and you can sell them. So it sounds pretty simple. But with this strategy, we're doing all four of those things, and then we complicate it further by we're doing multiple different strikes, and we're doing multiple different expiration cycles. So we're buying calls, we're buying puts, we're selling calls, we're selling puts. And we're complicating it slightly further by spreading our risk across multiple different expiration cycles as well as different strikes. So it's not complicated, but it approaches one of the most challenging strategies out there. I would say it's really not for beginners. However, we have trained and we've had a lot of newbie traders go through the workshop experience and come out of it with flying colors and profitable on a regularly consistent basis. So another reason why people don't trade this strategy, or they don't trade it very long, even if they have success with it, is it's very difficult to stay organized and get the trades put on timely and know what's coming up and when it's coming up. And you'll see with some of our background tools that we have taken all of that difficulty in staying organized with this strategy out of your hands, and we provide you tools in which to keep you on top of your game every week of the year, every trading day of the year, through each and every earnings quarter. So let's see, deciphering the optimum time to initiate the trade. Knowing what, all the ins and outs and the nuances of the trade. These are all things that we do in the workshop experience to train people on how to implement this strategy, stay focused, and reap the rewards of your efforts. So there are quite a few different variations of the double eagle. It's not quite exactly the same trade every time, and usually the variations come because we're dealing with estimated dates on earnings. We've determined that the time to put this trade on is about 4 to 5 to 6 weeks ahead of the earnings event. Okay, somewhere in that zone is where we generally initiate the trade. But if a stock like Facebook, for example, never announces when their earnings date is going to be until about 2 to 3 weeks before the earnings event, and therefore to get the trade on timely, we need to put the trade on before we know for sure when that earnings event is going to be. And depending on the sets of circumstances that we're faced with in estimating that date, and the standard deviation of time in time of when that earnings date might determine which of the varieties of the double eagle we decide to put on. And I'll show you again. You'll see how our tools help assist the traders in making those decisions. Okay, so we know which strategy usually works is the right one to put on at the time, even ahead of knowing when the actual earnings event is going to be. And so looking at these different folders, this is just all the folders that are in our Facebook folder. We have a major folder in our database that for each of the stocks. We have about 100 stocks. So you can see there's the Facebook Double Eagle Conventional, 24. There's a Double Eagle Conventional. There's a Double Eagle Long Extra Weeks. And then there's summary reports. I'm going to skip past the summary reports. I'm going to show you a sample of the summary reports. We'll skip past that. And then we have a couple other varieties that are short 1 week 32, we call it, short 1 week 39, we call it. So we've got all these different varieties. And I'm going to show you some of the tools that we use in the actual database and walk you through a little bit of the process, okay? So tools that we use in the background to keep our traders on top of their game. Let's get started. Now, the option slam, it says here at the bottom, proprietary, not available for distribution. That's going to be true of most of the rest of the tools. The option slam backtesting tool is actually a tool that's available to our insider members at optionslam.com. And it is not proprietary. It is available for distribution. All you need to do is be a member at optionslam.com and you will have access to the OSBTT. So let's go ahead and I'm going to walk you through a little bit of the process of what we do. So let's go over to the OSBTT and let's do a back test. I'm going to do this quickly. If you want to learn more about the OSBTT, I would suggest you go to resources, Option Slam webinars, and I'm sure there's some examples of the use of that tool in there. Right now, I'm just going to go and demonstrate a quick trade. All right, so we go to OSBTT. We enter in here the symbol that we're interested in back testing. And then we enter in a trade date. I'm going to start with a trade. I got ones that I've identified that I want to illustrate with. It's 09/25, 2017. So September of 2017, a year ago right now. So this quarter, this same quarter that we're in a year ago. I'm going to also show you a trade that I have on live this quarter right now, a real trade that I'm currently in later in the broadcast today. So let's look at a historical trade, and then let's look at eventually here later in the session, I'll show you a live trade that's ongoing right now. So we get the stock symbol and the trade date, the date we want to back test. We hit the next button, and then let's select. By the way, we are really making some great strides. We're going to be releasing, I hope very soon, a new version of OSBTT, which will have we have all these canned items in here, but I expect that we're going to have a custom combo in here and a few other more pre-canned strategies. All right, so we'll select double calendar. Long, let's select the front expiration date of 10/27. We'll the back expiration date of let's see, 11. Oh, I might have this wrong in my notes here. I think 11/17. All right, let's try that. And then I think that was the correct strike. Then we'll use the 155 strike. What we teach you in the workshop, how to choose all these strikes, how to choose these expiration cycles and all that. Not going to get into that today. That's what we learn in the workshop itself. Then if we execute trade, we click that button, execute trade, and we immediately get a set of results down here, which gives you the trade date, which we chose 9/25. What was the price of the underlying stock? This is the report that you get once you execute the trade. And then how much did that option strategy cost? It was a debit of $316, and it was put on at the end of the day. This is all end of day data in OSBTT. So at the end of the day, if we put the trade on at the end of the day, well, it didn't have a chance to make a profit. So we always start out with a zero profit. Then you can see this trade went underwater. It was actually on day 1, 2, 3, 4, the fourth day in, or fifth day you might call it. It was down considerably, right? Down about $100 on a $316 investment. So that's down about 30%. And then it came back, and then we see a lot of positive P&L results here. Okay, so let me So then what you do with OSBTT, or what we do, is we use this button, download to Excel, okay? And bear with me, I'm going to have to find that file. One more minute. Okay, so let's see. All right, so yeah, we use that, and we use the download to Excel button, and then what we do is we start saving that data. Now, this is let me blow this up a little. Can you guys see that okay? Yeah, I'm not going to take the questions right now. I'll read the questions at the end because I'm already quite distracted due to some personal issues. My son was in an automobile accident, and I'm spending a lot of time at the hospital, so I'm very much distracted. So bear with me, please. So this is, as you can see at the bottom here, are tabs. All these tabs refer to earnings dates, okay? The tabs are named by earnings date. So these are all historical trades that were created in the OSBTT and downloaded to Excel simply by download to Excel button. Now, this information here on these tabs, in these trades, I'm not showing all of the data that you get, but you will, if you use that button, you'll see the data you get. We also have a macro built in to convert some of the data and add the P&L percentage formulas and things like that. There's some other data that we collect that goes into our master database that is not available yet at the OSBTT. We collect that other information elsewhere, but it's all available to our subscribers who take the workshop because they get it in the management statistics tool, all of the summary data. So if you take a look here, let's just look at a couple of these back tests that were out of the OSBTT, downloaded to Excel. Again, you can see that we have a trade date in this example. The stock price on that day was $175.99. This is all Facebook. I'm using Facebook today pretty much exclusively to illustrate some of the points I want to make. The option value, in other words, meaning the debit to enter the trade. Now, the next day, the option value was $286, so that's $26 more than the day that it was worth before, so that means the trade was up exactly 10%. In the first day, okay? Now, I've highlighted yellow here. You can see there's some opportunities that if you look at these profits, there's some opportunity for absolutely huge profits in this trade. Not every trade is a winner. I already told you that about on average in our historical data, unmanaged, we have 69% winners. But, our goal, one of our goals in trading this is to minimize the losing trades. So that's what a lot of these background tools help you do, improve those statistics so that there's more winners, larger winners, and less losing trades. So you'll notice on some of these pages, I've got, this is kind of a side note, and another reason why we use estimated date trades, and we actually enter the trades prior to knowing when the earnings date is going to be. Yes, the trade is definitely revolves around an earnings date. It's the earnings date. It's an earnings trade. It's a pre-earnings trade. Without the earnings date, this strategy would not. I'm not going to say that it wouldn't work, but it certainly wouldn't work as well as it does. The reason that these cells are highlighted is that this is the date that Facebook had a press release announcing when their earnings date was going to be. We were in the trade multiple days before that in this particular example. And you can see what happens to the profit. Let's just look at the percentage of profit. It goes from 11% before the announcement, before the press release announcing the earnings date, and it jumps to 21% upon that announcement. Well, Marko, that's not that big a deal. It went back down to only 4% within a few days, right? Well, not every example is going to be the same. In fact, they're all going to be different. Let's look at another example. Here was a press release on October 4th, and another example of this trade. Went from 11% profitable, previously 20%, 26% underwater, to 47% profitable immediately the day after. The stock price did change a few dollars. Did that have something to do with it? It may have, depending on where the strikes were. That may have had something to do with it. Let's look at another example. Here's a trade where we got in on the 6/19. The press release didn't come out until 13 trading days, which is probably more like 17 to 18 calendar days, okay? Almost 3 weeks later, really. Went from 22% profitable to 133. So this press release phenomenon really can have an impact on many of our trades. Is it always this dramatic? No. But is it fairly consistent? Yeah, here's a -3 to a +18. Again, yellow highlighted, press release date, following day, the press release shows up as a positive influence to our P&L in the trade. So this is one of the reasons why we spend so much time and effort and energy estimating dates, so that we can get into these trades very timely ahead of the press release. We don't know exactly when that press release is going to be, but we do estimate when the press release is going to be, as well as the earnings date itself. So I could go on and show you example after example after example of a losing trade turning into a winner, or a very slightly modestly profitable trade turning into 13% profit, tripling to 31% profit, literally overnight. Okay, and you can see I have many, many more examples, and I had all those P&L summary reports earlier that I mentioned in a previous slide that that go to that foundation. So let me take you now to, let's see. Again, I'm a bit disorganized, but we'll get through this if you guys bear with me. All right, so let's see. So we looked at the OSBTT. We did a sample trade. We downloaded it to Excel, and then I showed you how we accumulate that data, that information, across many, many, many trades, many examples of this exact same strategy applied earnings report after earnings report, right? We collect that data, we import it into our master database. I'm going to give you some glimpses of our master database now. Again, the master database is a proprietary and not available for distribution, but the summary results out of our master we do make available to our traders. So let's see. I'm going to blow this up full screen for a moment. So I'm concealing some information here, but I am showing, let's see. So you can see basically the first thing I want to point out to you, can you see the far left side of my screen over here? There's 2,691 records in the database. In other words, 2,700 basically examples of this strategy. This is across our 100 stocks that we focus on. That list is dynamic. It changes We share it with our traders who enroll in the course. We do not share it outside of that circle. And then we have all these statistics that we gather and use, and then we can, with this database, it's a very powerful analytical tool. By filtering different parameters and metrics of the trade, we can kind of zone in on what trade works best, when the trade works best, how long before the earnings event or the front expiration cycle to put the trade on, what strikes work best. I mean, we've just done our homework, and this particular file is testament to that. So as I just scroll across here, and I won't go into all of the different fields and all of the different data that's available here. I'll get to this section here, and I can show you here in this area. I've got the symbol column fairly well concealed there, but we've got the earnings EVR, the earnings volatility rating from optionslam.com that we calculate and provide into the master database. So we can filter by all of these different metrics and parameters. The trade date, the price of the underlying stock, how much the debit was to enter the trade. You know, is the trade better on the more expensive trades, or does it work better on the less expensive trades? How far was the strike spread between our put calendar, our call calendar? What were the results? What were the largest profits available throughout the duration of that trade? If it was okay, what was the specific earnings date? And you can see as I scroll up here, there's just literally thousands of these records here. So how many weeks of separation between the front and the back? You can see that there's 4, 2s, 3s, and 1s, basically, and there's some others as well. How many trade days? And some implied volatility build statistics. What was the implied volatility of the back expiration on the trade date? We'll get into that a little bit more. There's a bunch of statistics here. So if I go over now to the cumulative P&L tab in here. Now, if I take into consideration all four, that one slide I showed you earlier had 1,600 trades in it. It had filtered out some of the trades that we don't consider conventional. It was strictly the conventional trades that produced that 25 to 28% unmanaged statistic. If we take in the whole entire 2,688 trades, then the statistics come down a notch, but still very impressive with about an 18% return on investment or against risk. Okay, this is taking every single trade in our database, winners and losers, every variety of all the double eagles in the entire database. So still very impressive statistics. But we can't only just do the conventional. Sometimes we find that we need to have the flexibility to be able to do other varieties of the trade depending on the circumstances surrounding. Let me just show you, if I filter down, I'm going to take that off screen just for a moment. And I'm going to filter to show Facebook alone. Let me do this a quick moment. I'm going to take this down. Sorry, I'm struggling. I have to take it off screen, but I'll be right back to you. Now, if I filter and take out all those 2,600 trades, and I show you some results for just one stock. That's another way I can filter, is by the stock, right? And then we go to cumulative profit and loss. This in itself is a very powerful tool, part of our master database, analytical software, if you will. Now, I filtered down to only the Facebook trades. There's 44 of them total, okay? 44 total. This is all 44, all varieties of the double eagle, every different double eagle, not just the conventional, but the non-conventional as well. And you can see that Facebook actually outperformed if you compare it to all of the stocks results, Facebook outperformed with a 34% profit against risk, whereas if you'll remember, it was a 25 to 28% profit against risk. Well, it was actually 18% when we did all the stocks, all trades. Now I'm going to filter one more time. I'm going to filter and take you to just the conventional trades on Facebook. And okay, so that was all 44 trades. Now I'm going to filter out all of the non-conventional, okay, and show you the cumulative profit. So now this is now you can see the 44 came down to 22. So 22 of the trades were conventional. And you can see the conventional trade way outperforms the non-conventional. Why do we trade anything but the conventional? Again, because we're trading this strategy on stocks that do not, for the most part, announce their earnings events soon enough to get the trade on to take advantage and have the opportunity for larger profits. So if you were to trade only the conventional on Facebook, it way outperformed. This is probably one of the better performing stocks. Obviously, it's probably, you can see on day -1. 1 day ahead of 0 day, 0 day again being the front expiration day, 60% profit was the average P&L against risk on this particular stock. But again, we can't do just conventionals. Oftentimes we are doing non-conventional strategies as well. So half of the trades were non-conventional, was excellent results. What was it? 34%. The other half were conventional with super results approaching 60%. Okay, so there's a little bit of a glimpse at the master database. I'm telling you, I'm just barely scratched the surface of what this can do. But from this tool, we then create our profit and loss summary reports. The profit and loss summary reports take all of this information and data and summarize it, and we then publish that data into our management statistics tool. So now let me show you the P&L summary report of Facebook, or one of them anyway, one of the P&L summary reports. And here is one of the P&L summary reports of Facebook. So this, quickly, I'll just go across the, and again, we have all of this data on all 100 of our stocks, okay? So it's literally years of work and accumulating data that's gotten us to this point. And so let me go through. So we got the symbol, the earnings volatility rating, the trade date, what was the price of the underlying on the trade date, what was the debit of the trade, what was the strike spread. This is important for option traders to know. What was the historical strike spread between the put and the call when the stock was at 111 versus what was the spread when the stock was at 78. Things like that are all things that help us analyze whether or not to take a trade. What was the profit available? And of course, the actual earnings date of that was in play on any specific trade date which again was over here in column D. Then these are the mean and median results, simple formulas that all of this is automatically through our programs uploaded to the management statistics tool, which is available to our traders 24/7, 365 at the click of a button in your browser. Okay, it's published right in the browser, and our traders have access to all of these summary statistics in these two lines, the mean and median. You know, to publish all of this data would just be too difficult and complicated and subject to misinterpretation. But what we do provide is the mean and median results, and I'll show you that coming up here in just a moment, a sample of the management statistics tool as well. So let's see, liquidity rating is another tool that I'll just describe it briefly. We rate the liquidity of all of our stocks. Our stocks don't make it to our list unless they pass a battery of tests. That is back testing tests. They have to show that they can perform with a strategy. The strategy does not work on every stock. It only works on certain stocks, and we put our stocks through a battery of tests before we add them to our list. We just took a couple stocks off of our list recently that no longer met the criteria, and we are evaluating about a dozen more stocks right now that we are considering to add to the list. We did add 3 stocks, I think, last month. Took 2 stocks off, and we're looking at about a dozen more now. Liquidity rating. Quickly, briefly, I'm not going to show you that tool, but that's a background tool that we use, and it's not like your broker's liquidity rating. I know that Thinkorswim and Tastyworks and some of the other brokers rate stocks for liquidity, but what we rate for liquidity is specific to this trade. It is not the front week or the front month at the money options that we rate. We are looking at options that are out in time, and we're looking at weeklies and monthlies. We're looking at strikes that are out of the money strikes at and around the strike where we're going to specifically put our trade, and we're looking out in time, out of the money contracts, and we're looking at quite a few different metrics. We're looking at option volume, option open interest. We're looking at bid-ask spread in relationship to the price of the underlying stock, and quite a few other factors in developing our liquidity rating of our stock. So you'll see in our management statistics tool, the actual liquidity rating is provided to our traders. The Trade Buddy is currently it's a very powerful tool to help traders decide whether to enter a trade, first of all, and then it assists in trade management going forward. It is not available to our traders yet. It is in beta testing mode by our research team, and we hope to be able to release it sometime within the next few months, but it is not available for release yet. Estimate next ER date is a tool that I'd like to show you that we work with on pretty much every day of the week, almost 7 days a week. And let me show you a couple of things about the Estimate next earnings release date. Let me put my password in there and get that. Okay. All right. So so this is a little glimpse. I've hidden our symbols here, but this is let's go scroll to the top so you can see these columns. The management statistics tool is derived from a variation of this specific sheet here that you're looking at, But I just want to give you an idea of the amount of stock. So each one of these lines is a different stock, okay? This is stock A, this is stock B, this is stock C, okay? So what we do here is we have a recommended trade date or a suggested trade date, and you can see that September 10th, we had quite a few stocks that came up on our list that we had available to look at to consider whether we wanted to put the strategy on or not. September 17th was probably the busiest week of this particular quarter. And then September 24th, things slowed down a bit, but there's still a lot of stocks to choose from. Here we are on October 8th. And we've got about 7 stocks here that are on our table for us to analyze, evaluate, and determine whether we'd like to apply the strategy. We can model up the strategy. We don't put the trade on every stock every quarter. That's why we need 100 stocks. Another reason that we trade estimated date trades, by the way, is that you see these highlighted in green. Well, these are confirmed dates. If it's highlighted in green in this column, column D, that is the earnings release date. If it's highlighted in green, we have confirmed the date. If it's not highlighted in green, it is an estimated date. Now, at the time of the trade, on trade date, suggested trade date, generally speaking, 1/3 of our stocks are confirmed. 2/3 are not. So if we only traded, because I get asked this question a lot, well, why not just trade only confirmed confirmed dates? Because there is opportunity, as I showed you in that back testing records at Facebook, putting that trade on well in advance of the press release, well in advance of knowing when the earnings going to be, there are benefits, there's opportunities for quicker profits and even better profits on many of our estimated date trades. Many of our estimated date trades actually outperform our confirmed date trades. Not necessarily every one, but again, through the analysis using our master database filtering that I kind of alluded to earlier, we can come up with a lot of conclusions like that to dial in on what's important and what trades to take, which ones not to take, et cetera, et cetera. Now, the workshop begins this coming Saturday, and then the following 4 Mondays, and you can see next Monday is the 15th. There's quite a few stocks that are going to be on our list, on our plate, that we'll be able to evaluate next Monday's session and decide whether it will model up the trades on those stocks, and we'll decide whether to get in or not, and we'll just take a look at the pros and the cons and what strikes to use, what expiration cycles to use, what things to consider. But I purposely do the workshop at a time when things are slowing down. You see, we're doing it after the busy season. Remember I showed you here the last few weeks were our busy season? We're holding the workshop immediately after the busy season, right here, starting it next week, where our first Monday session will be October 15th, then the 22nd, etc. We're going to have 4 Monday sessions. And then as we roll over into December, and then these will be the first week of January, right? When January comes around, all of those who have taken the workshop will be pretty well versed. They will have gone through a month of trading side by side with me and the others. We'll have adjusted some trades. We'll have opened some trades. We'll have closed some trades. Like I said, adjusted some trades. We'll have had some winners. We'll have had hopefully not very many losers, but that's part of the game as well. They can't all be winners. And then these will roll over into be January dates. The first week of January, the second week of January, and you'll see that the next quarter, but you'll have some experience under your belt, and then you'll be ready for the busy season. I made the mistake one time of having the workshop right before busy season, and a bunch of traders got themselves in trouble because they were all geeked and all excited about getting on the trade on as many stocks as possible, and they had never traded the strategy before. So I made that mistake once, and everybody came out of it fine. There was no disasters, but it's just too much to handle. So we want to start you out slow right after the busy season, and then we'll get some experience under our belts through these slower times, and then you'll be surprised how fast time goes by, and then within just a couple of months from now, we're going to be right back in to a lot of opportunities. So let's take a look at estimating. You can see a lot of these are not green, a lot of these are not confirmed. Let's take a look at the part of this tool in the estimate next earnings release date tool that this is an algorithm that my good friend Patrick actually built. I had started a very crude version of this, and then Patrick took the bull by the horns, and this thing has evolved between the research team, my efforts, and primarily Patrick's into a powerful earnings release date and press release date algorithm that predicts when the next press release is going to be, as well as the next earnings date. You see highlighted in red over here is where our algorithm or our final analysis of the estimation was wrong. As long as we get the right week, we're okay with this trade. If we get the wrong week, you can see we had estimated May 2nd, and the actual earnings was 425. However, all of these examples, we were right on. Okay, we have a very high statistical record of estimating our dates accurately. Do we get them wrong once in a while? Yeah. Right there, we got it wrong that one time, okay? So what this tool does is it looks at all the previous earnings release dates. It calculates how many days that release date was since the previous earnings release, and it keeps track of them quarter by quarter by quarter, and you'd be surprised how some stocks might have an average of a very low number in the first quarter and a very high number of days that pass in the fourth quarter. But this is a stock by stock analysis. Nothing is stagnant or steady or constant across stocks in this kind of analysis. This is an individual analysis of each of our 100 stocks in estimating dates. Now, again, a third of our stocks, we don't even have to estimate the date. They announce, we know that they announce well enough in advance. So anyway, this specific tool actually produces a prediction, and then we can manually tweak that prediction based on a bunch of different criteria that we take into consideration. I'm not going to go into all that now, but believe me, we have people who are working on this constantly every day to provide the information to the management statistics tool. Okay, so there's a little glimpse at the estimate next ER date file, along with the schedule of what's coming up and when it's coming up, and then we provide to you, the trader, information. Some of these Excel workbooks just keep coming up. I'm not going to close them just in case there's questions about them later, but let me move them over to another screen so they don't keep popping up on that screen. Okay, so the estimate next ER date, and then what else do we have? The IV Build Forecaster is another tool that we are. I don't have time to model that, but that is another phenomenal, powerful tool that we are currently developing. So again, whoops, let me back that up. One slide. The above tools are either under a development or proprietary and not available for distribution, at least at this time, other than the option slam backtesting tool, like I mentioned earlier. All right. moving on. This obviously we're going to go a bit over time here. We got a little bit of a late start, and but I'm moving along as quickly as I can. Okay, so let's see. Okay, so let's see. The next, I'm going to go to the next slide, I hope. Clicking on it. Okay, so here's a glimpse at the Double Eagle Management Statistics tool. This is what all of our traders have access to. If you join the workshop, you will get access to this for the first quarter. After the first quarter, there is a small fee involved in maintaining this tool, and it is strictly optional. You can trade the strategy without this tool. You do not have to have it, but most of our traders find it very helpful in especially knowing what our confidence level is and our current considerations of which trade to take, which variety of the Double Eagle should I take. Should I take the short 1 week earlier variety, the long 1 week later variety, or should I even consider maybe doing the trade with monthly contracts only? You know, there's, again, several different varieties, and notations are made right in the management statistics tool. Along with, if you'll remember, in the bottom of that summary report, remember the summary report, I said we provide to you the mean and median calculations of all of those important metrics, the average price of the symbol, in how many tests there were, how many back tests there were of that specific trade on this specific stock. Again, this is the symbol. Symbols are hidden except for Facebook. Let's focus on this Facebook line, which is the blue coding, the blue shading. Only purpose is to help your eye to follow that line across. It has no other meaning or implication. So, what are we predicting the press release? Well, at the time this slide was captured, this was, at the time I captured this screenshot, Facebook had not announced. Now they have announced, and I'm going to show you my trade here in just a moment. So let's see. At that time, we were predicting October 4th. I don't know if we nailed that or not. Honestly, I don't remember. We were predicting the earnings release date to be 10/31. We were suggesting a front expiration date of a certain date, and that's the trade that I took. We were not predicting. We were condoning the conventional trade, and that's the trade I took. There is risks in taking these trades, especially on estimated date trades. Okay, there are things that can go wrong. I'm not trying to paint a all roses picture here. Okay, so if we get the date wrong and you take the conventional trade, that trade is very likely going to turn out to be a losing trade, 30 to 50% against risk. The good news is that wasn't the case this time, and as I showed you, we have a very good history and record of predicting accurately. So let me get across these. Here's the liquidity rating. You see that we have some A's and B's. Most of our stocks actually have a C liquidity rating. We do have a few D's, and once a trade gets the grade, this is like, you know, college grade system, A, B, C, D, and F, okay? Once a stock gets an F, it won't stay on our list very long. We will remove stocks that get that F rating in liquidity. Even D's are a little bit more challenging to trade, but they are tradable. I trade them all the time, every quarter. I absolutely have trades on some lower liquidity stocks all the time, pretty much every quarter, almost every week of the year. Average price of the underlying symbol in these, let's look at Facebook again. 15 is the number of historical trades here. The average and median maximum profits. So the average maximum profit in these 15 trades was 132. The median maximum profit in these 15 trades was 94, and the lowest four profits were 9, these are max profits. 9, 43, 52, 58. Somebody asked me by email, and I already answered it earlier today. Well, how do I know which trades were losing trades and how many trades were losers winners? Well, I don't know. It depends on the management of the trade. But let's look at this stock up here. It had a -2, was the highest max profit. Guess what? There was never that. What that tells you is that there was never an opportunity to have a profit in that trade. In fact, the best you could have ever possibly done was lose only 2%. Now, if you would have been in that specific trade, you would have probably lost a lot more than 2%, right? Because you were holding out for an expected average profit of maybe 50%, right? Based on our statistics. Even this 12% profit probably, very likely, could have turned out to be a losing trade, depending on the trader and how it was managed, right? But there were 18 trades here. If 50% was the median, that means 9 of those trades were less than 50% profit, and 4 of them are listed here for you. So if 4 of them are listed, 5 more must have been higher than 29 and under 50. You follow the logic here? And 9 trades were over 50% max profit. So I got 9 trades under 50%, 9 trades over 50%, and the lowest 4 percentages are listed here. This I will teach you how to use this tool and these statistics. We do not sell, we do not provide this sheet to anyone who has not taken the course. So I get that question all the time. Can you just provide me? I'd like to buy just the management statistics tool, but I don't want to take the course. No, we don't do that. We provide this only to those who take the workshop, because too much of this data is subject to misinterpretation until you've been trained in how to interpret it, read it, and use it. And that is much of what we do and what we cover in the workshop. So implied volatility statistics, how much was the implied volatility on the trade date? How much did the implied volatility build throughout the trade, up and through and including front expiration day? So all very important statistics that our traders use and depend on to stay focused, organized, and profitable in the strategy. Okay. Now, let's see. Let's move on to the next slide. PL summary report. I think we showed you this already. I thought I showed this sheet already, so we'll move on. Again, these mean and median numbers from the PL summary report go to produce, in addition to the statistics that come out of that other sheet that I showed you, the earnings release, estimate next ER date workbook. So we accumulate statistics from this P&L summary report, plus some statistics from our estimate next ER date workbook, and from our master database, and all of that goes to producing the management statistics tool. All right, so moving on. Now, I showed you all the tools that are not included in the workshop. Here is the list of tools that are included in the workshop. If you take the workshop, which starts this coming Saturday, by the way, you will get access and a copy of all of these tools. I'm not going to go into the description of all of these tools today because I did so in the previous webinar. Again, those webinars are available on YouTube, as well as, I think, if you're an insider member at Option Slam, you can go into the archived webinars and see one of those webinars that describes the strategy itself. I'll just read what they are. The trade tree for entry decision is a flow chart that helps you decide and gives you this a play-by-play, step-by-step analysis of how to decide whether to enter a trade or not, okay? Go through all the details on how to use all these tools in the workshop. Flow chart for management decisions. So this is another flow chart, another tree type of a graphical that takes you step by step through if a trade gets to be challenged and price isn't behaving, or for whatever other reason you decide that a trade might need some adjustment. The first Monday of the workshop is primarily about all the different adjustments that we can use and apply to a trade that is challenged. But then the flow chart helps walk you through the steps to decide whether to adjust and which of the adjustments might make sense. The strike selector is just what it sounds like. It's a tool that helps you choose the specific strikes in your double calendar, the put strike and the call strike for your double eagle, and it helps prevent mistakes. We want to minimize the amount of mistakes we make. It is a fairly complex strategy setup, so we want to minimize the mistakes at entry. We have the most control of our trading at entry, right? Once we enter the trade, now we just need to, if we entered a good trade and we made the proper decisions, we chose the proper expiration cycles, we chose the proper strikes, we chose the proper stock based on the set of circumstances that we've analyzed, we have control. But once we pull the button and we're now in the trade, now the market is pretty much in control unless we decide to make certain adjustments. Okay, the adjustment matrix is another tool that helps you decide and reminds you of all the different adjustments that are available. Personal support by email, and even more personal than that if we need to get online by phone or private GoToWebinar session. I do those all the time with traders who need some personal assistance. Management statistics PDF, that is the tool that I've already illustrated to you. That is the management statistics. That is the tool that comes, you have access if you take the workshop through 12/31/2018, included in the price of the workshop. After that, it's $100 per quarter, not per month, per quarter. So about $1 a day is what it costs to maintain that. The access full 24/7, 365 days a year. Access to that tool is available for only $100 per quarter. The first quarter is included in the workshop tuition fee. So let's see. I do not, again, I'm going to look around. The cost of the workshop is $10.85. I'm not, one of these great salesmen that tell you that all these things, this tool is worth $500 and that tool is worth $800, and add all these things up and it's all worth some phenomenal amount of money. This is a steal of a deal, in my personal opinion. You get an extreme amount of training and coaching by yours truly over a period of time of about almost 5 weeks. Each course, each class, each webinar session will run a minimum of 2 hours. Almost all of them will run probably closer to 3 hours. That is the URL, and it's pretty simple. You just type into your browser optionslam.com training course. That will take you to the place where you can sign up. I'm actually going to bring that up on the screen. Let me just quickly run through a few of the testimonials from previous workshop graduates. Wolf says, the Double Eagle stands out as the trade for me, and I am appreciating it more and more as time goes on. I must tell you that I really appreciate what you shared concerning the Double Eagle workshop and how you did it. It was well worth the cost. Next guy, Rudiger. Rudiger from, I think, Germany, says, I found the workshop very good. All details of the trade were laid out so that I can understand it quickly. I have traded the Double Eagle successfully. Rick B. says, I feel that the Double Eagle workshop was very worthwhile. Your explanations were easy to follow, and having recordings of all the sessions enables me to review any of the material again and again. The DE concepts appear to have been thoroughly backtested, and I like the fact that the system provides a large set of trades which, by their link to earnings, recur quarterly. That's right. We have 100 stocks, but we have 4 opportunities every year to trade those 100 stocks. So that's 100 opportunities per year that we have to get into a Double Eagle trade. The workshop was a great learning experience. Eduardo says, the workshop was a great learning experience. Thank you very much for your leadership, patience, and willingness to share your experience and knowledge. I appreciate it very much. Then Eugene says, you teach principles in a way that is very understandable and easy to apply. Impressive is the research and backtesting that you bring to the table and share. You even go so far as to take the guesswork out of the trading equation by sharing your research. Many people teach trading mechanics. You go the extra mile when you share your research and tools. Thank you, thank you, thank you. And thank you too, Eugene. So let me take you, apparently that's the end of the PowerPoint. I'm going to open up that, let's see, that was the OSBTT. Okay, let's go to, I'm going to take you to that sign-up page, because if you go to this URL, optionslam.com/training course, this is where you can, if you're interested in joining us in the next workshop, this is where you have opportunities to buy either through PayPal or through directly with a credit card, not with PayPal. It's only $10.85. It includes all of these tools plus a quarter, one full quarter through 12/31 of the management statistics tool. It starts this coming Saturday, October 13th at noon Eastern time. All times are posted in Eastern time. That's the same as New York, New York. Okay, I am not in New York, but I am in the same time zone as New York. All sessions are recorded and provided to you for download to your hard drive. Once you download the webinars to your hard drive, you will have them forever. And many traders have told me many times that they watch the recordings over and over again, and then they get more out of them each time that they watch them. There's a lot of material in these sessions. Sometimes I'm talk fast and you might miss something, so it's very worthwhile for you to go back. I get a lot of questions by email from people who've taken the course, and I answer every question personally by email, but I also will tell you that 98% of the questions I get, the answer is in the recorded webinar. If you just go back, you will find the answer in the recorded webinars. Granted, there's over 11 hours of recorded webinars. There's actually probably closer to 15 hours. In our last workshop, there was 15 hours of recorded webinars, and I very much suspect that will be true again this time. This 11 is a lowball estimate of time that we will be spending. It is every Monday during trading hours. It is not necessary for you to be at the webinar live. The recordings will be provided the same day, as long as there's no issues in rendering and processing the recordings. They will be provided within a few hours after the conclusion of that webinar. The material is not that time sensitive. If I put a trade on Monday, October 15th, and you don't get the trade on until Wednesday or Thursday, I don't know if your trade is going to be more profitable or if my trade is going to be more profitable. There's no way of knowing until we get to the conclusion of the trade. We never know when is the best day to put the trade on. We just evaluate, and I'll teach you how to do that. We analyze, and then we weigh the situation and make a decision. So that's all about what we teach in the workshop. is how to make all those decisions on a day-to-day basis. But the point is, the material is not that time sensitive. I've had many people take the course that never attended a live session. Okay, most people do not attend all the sessions live because, let's face it, we're busy people. We have other things to do. Other things come up. Life doesn't always go as planned. It is not necessary to be there live. All sessions are recorded. I do have people who back up the recordings, so if my recording fails, which has happened a few times, we have other people who are backing up the recording on their computer, and therefore, so far, to date, we have never missed one. We have had to resort to our backup folks a couple times, but we have a 100% success rate on being able to provide recordings to every single session. So, having said all that, I am going to take a quick look at our questions box here and see if I can answer some questions that may have come in. Oh, I forgot to show you that trade that I have on. I was going to show you a live trade, so let me do that first before I look at questions. If you want to type your questions in the room, I will take them. I apologize for going over time, but that's the advantage of doing this in my own forum here at optionslam.com as opposed to someone else's. By the way, I'm going to be doing another webinar, the arrowmirror.com. Let me give Arrowmirror a plug here. I'm going to go to AEROMIR. Arrowmirror, give Arrowmirror a plug here because they support us. And if you go to Arrowmirror, I am going to be doing a webinar for Arrowmirror this Wednesday at, I think, 11 o'clock. I think you can join for free and get invited to that. And the webinar this Wednesday is going to be a repeat of the webinar I did last Monday. It's going to be pretty much a repeat of what's available on YouTube right now. But the Arrowmirror folks have requested that I present to their group. We were also requested to do a presentation to the Raleigh-Durham Traders Group. The Raleigh-Durham, North Carolina Traders Group was gracious enough to invite us to present to their folks, their traders. A lot of really highly professional folks over there. We really appreciate Don from Raleigh-Durham, as well as Tom from Arrowmirror. And of course, Len over at OptionView is a supporter of our program as well as many other well-known and well-respected websites. Let's see. So Arrowmirror was going to be this Wednesday. Okay, and then I was going to show you that trade. Let me get to that. Sorry, I didn't rehearse this. That's why it's going over, because I've just been too busy with some personal issues here. Let me find that. Pretty sure I got it open. Yep. Okay, so let's take this back to September 27th, I think is when I put that trade on. No. Okay, so this is a live trade. Let's see, September 24th. Let's go back another day. I'm going to take you back to the first day of this trade. Okay, there we go. That must have been it right there. September 21st was the first day of this trade. So as I said, these trades do not look pretty the first day you put them on. As you can see, this risk graph is completely below the zero line. It looks like there is no way to make money with this trade. Not only that, but I got off to a bad start with this trade. I got into this trade, as you can see down here, for $285 per contract. Generally, I illustrate these trades with only one contract. Let me blow this up. I'm going to just blow this up to, An error occurred, it says. Please notify. Well, let's see. Yep, it looks like an error definitely occurred there. Let me see if I can pull that up again, and I won't reduce it this time. I don't think. I'll take another chance on that. All right, hang on a second. It's going to take me a minute to get that thing shut right down, didn't it? So give me just a moment, and we'll see if we can get that back up. And then I'll show you that trade. My other screen is really crowded over here, so it's taken me just a minute to find it. Okay, here we go. Bear with me. You can type questions in the room. I will take a moment to answer questions. I gotta remember my password. Okay. And this will only take a moment to fire up. What did I say it was? September 21st? Was that the trade date? We'll try it. Let's go to Facebook. Let's go to Marko Live Trades. Let's go to September. I think that was September 21st, I think. Let's try the 20th. Okay, go forward a day. There's the 21st. Okay, so I got in at a disadvantageous price here. I'm not gonna, rather than do what I did last time that crashed the program, I'll just widen the screen manually this way. Okay, now it's easier to see. Oh, wait a minute, and then I lose my statistics over here. So let's see. 285 was what I got in, but you can see it says by the end of that day, I must have got in sometime earlier in the day, right? I paid 285. By the end of the day, this was actually going for only 245. So I was $40 underwater on the first day of the trade. Does that happen often? That happens often enough. It happens quite regularly. We learn as we trade the strategy that oftentimes the first few days or the first week, sometimes even 2 weeks, the trade is somewhat underwater. People say, well, Marko, why don't you just wait for a week or two and then put the trade on? Well, we've tried that. That doesn't work. I'll explain why in the workshop. We need to get the trade on timely. It's important to get the trade on time. I will put the trade on maybe a week late of the recommended date, but never beyond that. Almost never beyond a week late, okay? Can we put the trade on early? Absolutely. We can put the trade on early. We can put the trade on the suggested trade date. We can put the trade on any time later that week. Suggested trade dates, the way we have it set up right now, are always on a Monday. Can you trade it the Friday before, the Thursday before? Yeah, you can. Let's take a look at this trade quickly, and then I'll go to questions. So here we are on September 21st, first day of the trade. I'm already underwater by the end of the day by 30, 40 bucks, representing about 10 to 15% underwater. Second day, still underwater. Let's move forward. September 25th, Tuesday. Still not happy. Marko's still not happy. On the 26th, things are perking up a little bit. Now we're only down 6% from the entry price. September 27th, down $72, representing a negative 25% on that trade. Honestly, folks, when this was going on, I didn't bat an eye. I wasn't concerned. I wasn't worried. I've traded this strategy so long, so many years, so many stocks that I know it will come. Is every trade a winner? No, there's losers. But I have so much faith in the strategy that I was never worried about this. So let's continue going forward. Friday the 28th, still underwater, $36 per contract, by the way. This is per contract. This is assuming that there was only one contract. All right, so let's go forward into Monday, October 1st, okay? Still underwater. We have not seen a winning day until October 2nd. Now, if you'll remember, we had predicted the press release was going to come out on October 4th. If I remember, our prediction tool that's in our management statistics tool predicted October 4th was going to be the press release. Well, we were a little bit off on that. But it doesn't matter when the press release comes out. The fact is, and the reason this trade just went from being underwater for the first week and a half to 2 weeks to all of a sudden now being above water at $86 profit overnight. It went from underwater, losing money, to $86, representing a 30% profit against risk overnight, is because the day before, after the close on October 1st, they had a press release announcing the date of the earnings date, and we had nailed it with our estimated date of October 31st. We had predicted October 31st. On the October 1st, they had a press release. They announced on their investor relations website that, yes, indeed, our earnings release will be October 31st, and as soon as that announcement came out, hit the street, implied volatility shifted in the options, making our long contracts way more valuable than they were the day before. And this, I did not close this trade. I could have closed this trade that day for a 30% profit. I have chosen to keep some of the contracts. So one of the management statistics in this trade is when you have a quick, fast, easy profit, lock it in. Book some of the profits. And then if you have multiple contracts, if you're a larger size trader and you have multiple contracts, you can book some profits and let a few contracts ride, looking to extend those profits beyond, hopefully into bigger and better numbers as the trade continues to mature towards front expiration day. So let's just take it up to today. We're only, this was last Tuesday. Let's see how, if that was a good decision. The trade the next day was up to $122 profit, 43%. And these things come and go, right? Here it's down to 38%. Last Friday, it was back up to 41%. And then today, the trade is still looking very healthy. So there we go. There's a live example of a double eagle in action. Trade still currently on the books. All right, now I'm going to try to take those questions. Let's see. You guys should see, probably seeing a blue screen right now. Okay. All right, let's see. Maybe I should at least get something nice to look at up there on the screen. How about we do this? And we show. You don't want to see my, I guess I'll put up, if I was a good salesman at all, I would put up the sheet that shows the sign-up page URL. Or better yet, I think I have that URL open. Let me put that up. Right there. This is it. That's optionslam.com /training course. There it is, optionslam.com /training course. Okay, so Aaron asks a few things. Let me just read this. Is it accurate? It actually makes approximately 25% per quarter using this. Aaron, it's going to depend on, I showed you our records of historical statistics of the trade, completely unmanaged. Some traders do much better than 25%. Some traders are not able to attain 25%. The more you trade it, the better you get. That I know, not only from my own experience, but from all the traders that I've trained and taught this strategy to. I know that I hear it time and again. The longer I trade it, the better I get at it. Many traders do much better than that, Aaron. These adjustments, things that you talk during the quarter, or do I need to work it through on my own? No, I teach all the adjustments that I am aware of in the workshop. Direction of move makes no real difference because of the way it is set up. That's correct. This is a non-directional strategy the way it is set up. It doesn't matter if the stock goes up or down. This is a delta neutral strategy on day one. When we put the trade on, it is virtually delta neutral. We don't care if the stock goes up. We don't care if the stock goes down. As long as the stock doesn't move too far in either direction, we like it to do what we say, stay between the tent poles. If you look at that double calendar risk profile, it looks like a circus tent, right? With two tent poles. If price stays between the tent poles, the strategy tends to work all on its own. If price goes through one of the tent poles, then we start looking at adjustment scenarios to deal with that adverse move. Again, the previous webinar talks more about that kind of thing, and of course the workshop, we get into all of those details. Luigi, does 16% return take into account trade costs? No, I do not believe, no. Our historical data does not take into consideration commissions. It's all of our historical data. Well, not all of our historical data. Most of our historical data is produced through the OSBTT option slam backtesting tool. It is theoretical midpoint pricing. Is it always realistic to get midpoint pricing? No, but I generally teach the strategy to be taken and look to get in lower than midpoint, at midpoint, rarely very far above midpoint pricing. I do not want to overpay for this or any other strategy. If I have to add a penny or two above the midpoint pricing for the four-legged strategy, that's about as far as I'm willing to go. Scott asks, thank you, Scott. Thank you. Yeah, my son is doing well. Yeah, thank you everyone for the well wishes. My son is doing well. He is in recovery. He will, we hope, make a full recovery here. It's going to take some time. How much can you lose on a wrong week guess? Generally, if we get the wrong week estimate, it's not a guess. It's not a guess. It is a closely analyzed, calculated estimate. And I pretty much, almost every quarter, I find myself in a trade where I am in a wrong date, or I'm in a wrong estimated date trade. This recent quarter, I don't think I had any of those. There are quarters that I can get through without ever finding myself in one of those trades. Those trades are almost always a loser. Once in a while, you can even work your way out of those. If we get an estimated date wrong, and we're in what I do teach, and I do recommend that the new people who take the workshop stick with the confirmed date trades only for the first quarter or even first two quarters that you're trading the strategy, till you get a hang of managing the trade, learning how the trade works, getting a feel for it. It takes a while. It really does. It takes a while to get a feel for it. So I highly recommend that you avoid the estimated date trades, because generally if we get one of those wrong, and you don't follow the advice of the management statistics PDF by taking a non-conventional strategy, if you take the conventional and you take all the risk in the trade and we get it wrong, the question is, how much do you lose? The answer is generally 30 to 50% of your risk. I have seen it as bad as 70%. There's quite a few traders in here who are trading the strategy. If you guys agree or disagree with anything that I'm saying, feel free to post. I'm glad to read your comments. If anyone who is currently trading the strategy would like to talk or discuss or answer any of the other questions, I'd be happy to provide you a microphone as well. I know there's quite a few guys in here. So let's see. Okay, so there you go, Mike. 30 to 50%, but generally you can work your way out of that and reduce those losses. But you know, that's the facts. Okay, Chris asks, are your Monday sessions during the day or at night? Chris, the Monday sessions are during trading hours. They start at 11 a.m. Eastern time and go till 1 or 2 o'clock in the afternoon. So it's right in the middle of the day during the trading day. That way we're working with live options chains and live pricing and real statistics, real situations. It is not necessary to be there during those sessions live. I provide them to you within usually by 6 or 7 p.m. That same day, because the sessions go from 11 to 3. Excuse me, 11 to. They're scheduled to be from 11 to 1, but they generally go till 2 o'clock. So 11 to 2. Then it takes 2 to 3 hours to render the video. 11 to 2, 3 hours later is 5. So somewhere about 5, 6, 7 p.m. Eastern time is when you will get a link in your email to download the actual video to your hard drive for keeps. Okay. Okay, so this is another question. If you have a dozen or more traders putting the same trade on the same stock, do you see it increasing the cost of the trade? I've never witnessed that phenomenon whatsoever. First of all, each trader has to decide which expiration cycles. We don't all trade the exact same trade every single quarter, right? Even if I put the trade on today, I might choose the 100, 115 strike, right? You might choose the 102.50, 112.50 strike, okay? Either of them might be unacceptable within our parameters. Either of them might meet the criteria that we set up and how we teach you to choose those strikes. But depending on your risk, risk tolerance, and depending on how your experience in trading the trade might guide you to go a little bit slightly wider than I do or a little bit slightly narrower than I do with strike selection. You might choose to use the monthly contracts, and I might choose to use the weekly contracts. So I don't teach you a hard, fast, solid. I mean, there are definite guidelines that you'll learn on how to set up the strategy. Definite, specific guidelines. But there's flexibility within the trade to customize it to your trading style. Okay? I hope that makes sense. All right. So no, I've never seen any kind of an issue with just because we got a bunch of traders trading a similar strategy on the same stock. We are not going to affect that options market. Just the few hundred of us that trade this strategy. All right. If there are stocks that have earnings this and next week, how does the activity of the last few days affect those positions? If there are stocks that have earnings this next week, how does activity of this last few days affect those positions? Is this an opportunity to close out with a greater than expected profits? Okay, I'm not sure if I understand the question, but we see, and you saw in those graphs, in the profit and loss risk, in the graph that showed the P&L percent return of our entire master database, that the longer you're in the trade, the higher the profits get. Does that mean that I can never get a profit early on in the trade? No. I closed a trade, and it happens not all the time, but I closed a trade for an extremely high profit just a few weeks ago after being in the trade only one day. 79% profit in only one day. Then about a week later, I found an opportunity to put a trade on that same stock again. Now I'm back in that stock again for the second time around, and the second time around, it didn't produce a big profit right away. I'll tell that story in the workshop, and I'll show exactly what happened. It was kind of an unusual case, but I think I'll find some time in the workshop, maybe towards the end of one of the Monday sessions, to illustrate what happened there. But yes, there's oftentimes when the trades cut, a lot of traders set profit targets. Okay, I don't. I don't set a profit target. I teach to trade the strategy, evaluate your position every day. Make it. You have a decision to make every day. Use only 3 things you can do. You can hold the trade and not do anything. Let it work another day. You can close the trade, whether it be for a small profit or for a large profit or a small loss or whatever the case might be. You can either do nothing or you can close the trade. Only third alternative is you can make an adjustment to the trade. If you, for whatever reason, have determined and decided and made the decision that you think an adjustment is appropriate, and we give you a lot of guidelines as to how to make those decisions and what adjustments to take into consideration, those are the only 3 things you can do. So that's what I do. I make those decisions, those decisions on each of my trades every day. I look at every trade at least twice a day, and I decide I'm either going to hold it, close it, or adjust it. Other traders set profit targets, and they actually even put orders in to close the trade at some predetermined profit target. I do not, because I think oftentimes traders take profits way too soon, way too early, at much lower levels than they could or should. Now, it's also true that if you don't take a profit when it's available, a trade could roll over, turn against you, and evolve into something that you kick yourself because you didn't take the profit when it was there, and now you got a losing trade. That happens too. It happens to the worst of us as well as the best of us. So learning, again, to manage the trade, initiate the trade, how to make the decisions in management going forward, it's an experience, and it's a strategy and an approach to trading earnings that takes advantage of theta and implied volatility and vega. And it is learned by doing over time. Okay. Hopefully that answers your question, Aaron. I'm not sure if I understood the question, but I gave it my best shot. Another question. Do you backtest for each suggested stock, different strikes? We have done all of our homework, Luigi. We've done all of our homework, and we did that back in the early days. Luigi's asked, do you backtest at different strikes for different stocks and a wide variety of strikes? Yes, we did all of that homework years ago. We've dialed in on what's the best strikes to use. We no longer need to test strikes that are way further out of the money or way closer to being at the money. We no longer feel the need to continue those we've come to our conclusions on that. Okay, we've come to our conclusions, and we know we dial right in on what strikes are going to be the most appropriate on trade day. Now, as time goes on, and you may find some trades, and again, I think I adjust. I would say I adjust approximately 1/3 of my trades. Do you other guys in the room agree? Is that a good number? Is that about the amount of trades that you guys adjust as well? Let me know. Now, as the trade goes on, you got a trade that you're adjusting. You may adjust those. You're going to be, when you adjust your trade, it's no longer the same trade anymore, right? Now it's going to be a different trade because you've closed some contracts, you've opened some new contracts, it's later in the game, you're going to be at different strikes. You're generally not going to be at different expiration cycles than you started with, but sometimes you're going to actually change expiration cycles too. Standard deviations start to narrow as the time goes on. Generally, standard deviations narrow as time goes on. So, yeah, the trade evolves over a period of 4 to 7 weeks, basically. Scott is a member of our research team, and as well as a graduate of the Double Eagle trading workshop. And Scott mentions here that Marko's teachings in the Double Eagle course will help traders with other strategies also. Well, you know, I'm glad you brought that up, Scott, because I got to tell you, I hear that from traders all the time. That Marko, I not only learned how to trade the Double Eagle, but now I have learned so much through the Double Eagle course that I'm better at trading all the other strategies that I trade as well. I understand them better and I can trade them better. I'm a much more effective trader all around through the experience of the Double Eagle workshop. So I've gotten that email many times over. Thanks, Scott, for bringing it up. I generally forget to mention that. Chris, excellent question. VIX is up 20% today. How does that affect our trade? Well, we have in our master database, we actually, let me see if I still have that open. And then this is going to be the last question that's going to wrap up the session for today. We're way over time. Let's see if I can find that. Master database, here it is. That's not it, but it is up here. Just a second. Darn it. Too many screens, too many screens. Okay, let me get over to, I just want to show you something that one of the filters that we can do, and we've done this. I want to answer your question with this example. So, what we have in this column, HW, in our master database, is what was the VIX? Let's see, where was trade date? Price of book. Okay, let's find here. Here's for example, line number 2272, June 19th, 2017. Where was the VIX on that day? It was at 10.37. Here's a trade date, was 18. This is the closing prices. This is end of day data only. Here's a VIX of 19. So what we have been able to do is actually filter by how did trades perform that were initiated on high VIX days versus low VIX days. So here's a VIX of 27, here's a VIX of 12. Generally, what we've done in the past, when we analyze that, we say, okay, let's filter our master database and let's take a look at how did trades perform that were initiated on high VIX days. Let's set a threshold. Let's say anything over 17, let's call that a high VIX. Anything under 17, let's call that a low or normal VIX. And it was very interesting to find out, and many traders were surprised. I personally was not, but many traders were surprised to find out that trades initiated on high VIX days actually outperformed not only in how many were profitable, but how high the profits were. Outperformed those trades. Now, is it true across the board, every single case, every single stock? No, but the majority of stocks, majority of trades that were initiated on high VIX days outperformed those trades that were on low VIX days. And of course, there's a lot more low VIX days than there are high VIX days, right? When the VIX gets high, it usually doesn't stay up there very long. It's a mean reverting index, isn't it? Okay, so anyway, I'll explain why that is. Not today, but in the workshop, I will explain exactly why high VIX days are good days to put on double eagles. All right? Okay, well, that will wrap it up. That's all the questions I see. I apologize for taking so long and being not as organized as I should be, but appreciate your being here and your patience and your excellent questions. Goodbye for now, and good trading.